Look, I mean, it's not just about the Fed meeting. I think it's about the whole of 2016. 2016 has been a challenging year. It's all about capital preservation. More than trying to make money, more than trying to chase yield, it's actually about trying to preserve capital. And I suppose it is about that. I mean, potentially at this stage in the cycle, higher cash allocation, protecting long-side equity profits, and think about some strategic hedges, some portfolio insurance, because going into the summer months, we potentially could see a pullback, if not, again, a more meaningful correction.
What do those strategic hedges look like? What are they?
I suppose portfolio hedges in the sense of offsetting. If you have long position, have an offsetting short position in the portfolio, not be net long only, right? I think net long only is not working this year. And you might have seen year to date the equity market is flat, and in between you had a huge rally and a major collapse going into January. So, but year to date the market is flat. So you didn't really lose out by being either in more cash or in a diversified defensive portfolio. I think what a lot of people are doing, they're chasing momentum, and that of course works as you're a trader, but as a longer term investor, there's a high risk in the market at this level, because historically speaking, markets are elevated and markets are expensive. US equities trade around 19 PE when the average is around 15 PE. So if you follow the just price earnings ratio analysis or scenario rather, you could potentially see that yes, if we get back to the historic average of 15, market has maybe 30% downside from here and limited upside of 4%. So to some extent, the risk-reward ratio is not favorable for net long only.
Okay, so it's looking pretty gloomy out there, I guess you could say. I wanted to ask you about something else more broadly. So you see emerging market export names that are US dollar sensitive potentially outperforming over the next 3 to 6 months. Correct. But is that ex-Japan, given, I guess, some of the concerns around a fiscal and monetary policy in that part of the Asian region?
Yes, I would argue it's ex-Japan, and in particular it's sort of more emerging markets, because I think one of the high probability trades is a stronger dollar. I think the Fed potentially could hike in June or July, and I think that potentially would mean the dollar could rebound. So against many emerging market currencies, long the US dollar seems to be potentially a very good risk-adjusted trade. And in those equity markets, companies that have local costs, and hence when the currency weakens and their exports will go up, so those potentially would make sense. So again, local companies that actually benefit from local currency weakness. I think that seems to be a good sector and a theme. But overall, I think the bigger problem is that corporate profitability is still declining. It's actually not that great, and this is what the earnings season showed us. It was a little bit better than expected, but the numbers are still not really great, and I think that hasn't really gone away.
If dollar strength will be a key theme going forward, what's your take, what's your call on those major dollar-denominated commodities like gold and oil, for example?
I think gold is slightly different, because gold increasingly is seen as a currency in its own right, in a world where we have maybe too much currency manipulation, if not misalignment. On the other hand, oil and iron ore and a lot of these other commodities, copper for instance, potentially could see a pullback, and maybe even more of a correction when the dollar appreciates going into the Fed meeting. I think we have already seen that. Oil at $48 a barrel looks very stretched. And don't forget, oil has risen 83% of the lows. After 80% move from the lows, there's a high probability it could pull back. And also don't forget, with oil at these levels, a lot of these producing countries now have ever more incentive to basically increase production, so that supply could come back into the market to bring oil back down.